Okay, so in the previous classes, we have seen about the theoretical part of the credit management. Today, we will start with the evaluation of credit policies. Practical illustration, we will be discussing how to evaluate a credit policy. If there are alternative policy situation available, which policy, credit policy you have to select, that will be determined using the technique evaluation of credit policy. So just now, just as we have already discussed, there will be present policy which the organization may be at present following. Okay. Then sometimes organization may think of changing the policy. So that will be proposed policy one. Then there will be alternative 2, 3, like that. Various different alternatives organization will think and compare it with the present policy. And out of this, which is the best policy that you have to select. Sometimes present policy may be only good. So we will reject all the proposed policies. Okay. Based on the calculation. Okay. So first, we will start with the benefits part. What is the benefit of giving credit to the customer? So that is known as expected profit, you can say. That is benefit part. Credit sales will be there. Okay, this is a benefit. Then total cost other than bad debts, etc. Then benefits will be there. Corresponding cost will also be there. Administration cost, collection cost, okay, other bad debts, etc. All this will be cost. So when benefit is exceeding the cost, that is when there is a net benefit, we will say you can go with the credit design, and out of that we should check where the net benefit is more. Okay, suppose in present policy net benefit is 100. In proposed policy 1 net benefit is 90. In proposed policy 2 net benefit is 85. Just for example. And in proposed policy 3 net benefit is 110. So we'll compare which is the best. So we'll say policy 3 company may adopt. So just we have to see the benefits, take the cost, then calculate the net benefit or expected profit. We will get the solution. Which policy you should select is the best policy. See, opportunity cost also we have to take into consideration, which we have already discussed. Opportunity cost means cost of foregoing an alternative opportunity. So if you are giving goods on credit, you lose many opportunities of investment in that investment of that amount in some investment opportunities. So that interest which we are foregoing, that you should consider for your decision making. That is known as opportunity cost of investment in receivable locked up in collection period. Because once you give credit on goods on credit, your amount will be blocked. So if you sold that on cash, you could have immediately received that amount and you could have invested that somewhere else. So that opportunity cost you have to take into consideration before making the net benefit calculation. So before that, everybody know the two formulas which will be required for calculating these problems. One is the total fixed cost and another is the opportunity cost. And total cost will be total of variable cost and fixed cost. Write down total cost other than bad debts will be variable cost plus fixed cost. So everybody should write down total cost other than bad debts will be variable cost plus fixed cost. So everybody know what is variable cost, what is fixed cost. We are not going that detail. What is variable cost, what is fixed cost. That you have already read in costing. So total cost for the company, organization, firm will be total of variable costs plus fixed cost. And how you will calculate the fixed cost? Average cost will be there, then variable cost per unit will be there. So difference between average total cost minus variable cost per unit will be your fixed cost per unit into number of units. If you will multiply, then you will get the fixed cost. Okay. Opportunity cost, how to calculate? See, total cost of credit sales. Total cost will be variable cost plus fixed cost total, which will be given in the question. Details of variable cost and fixed cost will be given in the question. We should take the total of credit sales cost into collection period. What is the collection period given by the company? Divided by 365 or 360. So sometimes in question they may tell that use 360 instead of 365. Why it is we use 360 normally is for the simplicity in calculation. Because if you will use a 360, you will get rounded answers. So for simplicity, instead of 365, you can use a 360 also, if it is mentioned in the question there. Okay. Then required rate of return. What is the return you are foregoing by giving the goods on credit? Okay. Divided by 100, because return will be in percentage. Okay. So simple opportunity cost formula, remember. Total cost of credits, which is nothing but variable cost plus fixed cost, which will be given in the question, into collection period will also be given in the question. Divide by 365 or 360 depending upon the question. If question is a silent, then you should go 365 only. Okay. Into required rate of return, that will also be given in the question only. Okay, so these two formulas everybody have noted down, then we can go with the illustration. Everybody comfortable this much? See, read this illustration. A trader whose current sales are in the region rupees 6 lakh per annum. Average collection period is 30 days. Wants to pursue a more liberal policy to improve sales. So what is said in the question, that current sales of a trader is 6 lakh per annum. So currently the trader is selling good, sales is a 6 lakh, and is giving a credit of 30 days to the customer. Now, this trader wants to make his credit policy a little more liberal. Means he want to increase this credit period from 30 days. Why he is thinking so? Because he thinks that it will improve his sales. If he will give more credit, then his sales will increase. Okay. So the present policy is 30 days. Now we have to see 4 new policies are given. See, this is the proposed policy A, B, C, D. Increase in collection period. So he is thinking of increasing it by 10 days. So already 30 is there. So new collection period will become 40. Proposed. Okay. 30, he is thinking of increasing it by 20 days, means new policy will become 50, 30 plus 30, 60, 45 plus 30, 30 plus 45, 75 days. So these will be the proposed policies. Increase in collection period is given. See, increase in collection period from the existing. So existing is 30. Correct. Existing is what? 30. So existing, if you will increase by 10 days, it will become 40. 20 days means 50. 30 means 60. And 45 means 75 days respectively. And increase in sales is given. Means current is 6 lakh. So if you will increase by 10 days and make the credit period 40 days, your sales will become 6 lakh 30. Okay. Similarly, you can calculate for other proposals also. Default anticipated means bad debts risk. See, more the credit period, risk will go on increasing. Understood? Current bad debts is 1%. Means if the credit period is 30 days, it is 1%. So if you are going on increasing it, the bad debts risk is increasing. See. Understood? Everybody is seeing this part. So sales is increasing, bad debts is also increasing. Selling price per unit is 3. Okay, average cost per unit is given 2.25, variable cost are 2. From this we can find out the fixed cost easily. Current bad debts is 1%. Okay, required rate of return is at 20%. And assume 360 days. Here in question they are told that please take it as 360 days. Based on this detail, we have to suggest which policy the company has to adopt. So everybody ready? Understood this question properly? Then we can start with our calculation. So now we will start with our illustration how to solve this. Present policy is 30 days and proposed policies are given. 4 policies are proposed by the trader. We have to select the best policy. So how we'll start evaluation of credit policies. Evaluation of credit policies. Particulars. Present policy. Proposed policy. We'll not write 1, 2 because in question it is given A, B. So we'll use that words only. 4 policies are there. Will be the evaluation of credit policies. So first we will write down the credit period in each policy. We'll start from there. Credit period allowed. In present policy, what is the credit period? 30 days. Everybody know present period 30 days is the credit policy. 30 days. So you can write here only days so that in each part you need not write again. Increase by 10 days means it will become 40, 50, 60, and 75 respectively. Okay. Sales in rupees. So present sales is how much? 6 lakh rupees per annum. 6 lakhs. Proposed sales will become 6,30,000, 6,48,000, 6,75,000, and 6,90,000. Okay. So this we have done. Now next we can write the cost, total cost. Other than bad debts. So total cost will always be variable cost plus fixed cost. So what is variable cost per unit? See, variable cost per unit is 2, and we know that variable cost per unit will always remain unchanged. Variable cost per unit will remain unchanged for any number of units. Okay, this point you should remember always. Variable cost per unit will remain unchanged for any unit, and total fixed cost will remain unchanged. That you have to remember. So variable cost per unit will remain unchanged. So it is simple. Variable cost, how we will calculate? Here only we are writing it. Variable cost per unit into number of units. So what is variable cost per unit in this question? 2. Variable cost per unit is 2. So very simple. We will multiply 2 with the number of units given. But here sales unit are not given. So how we can calculate? Selling price per unit is given and total sales is there. So based on this, we can calculate the units. See how we will calculate. Total sales is given. So how we can calculate the sales in units? Sales here instead of rupees, we will write units. How we will calculate it? Total sales divided by number of units. No? We will get the sales in units. See, total sales divided by selling price per unit. Okay, total sales divided by selling price per unit, and selling price per unit is 3 rupees per unit. See. Clear? So 6 lakh divided by 3, what will be the number of units? 6 lakh divided by 3. So first the units, then selling price per unit. So we have calculated the number of units here. Now we can calculate the variable cost multiply units into 2. This much everybody understood. Any confusion till now? This much everybody understood, yes or no? How to calculate the variable cost, total variable cost. Yes or no? Any confusion? Yeah.